Welcome to the Gray Report. I'm your host, Spencer Gray. And if you are a multifamily investor, an aspiring investor, or you are in the multifamily industry, really on the front lines working in the apartment industry, well, the Gray Report was designed exactly for you to try to give you the best up-to-date information so you can make the best decisions when you are contemplating a real estate investment, or if it's just to stay on top for your job in the multifamily industry. We've got a great guest, Noah Stone from Berkadia, from their thought leadership group. Really excited to have him on. He's been putting out a lot of great pieces, looking from the macro lens, how inflation is affecting commercial real estate, multifamily economy in general, just taking a different viewpoint than many others are. And so, really excited to have him on. Let's bring Noah in and let's get into it. All right, Noah Stone from Berkadia. How are you doing today? Welcome to the Gray Report.
Doing well, Spencer. Thank you very much for having me on again. Appreciate it.
Absolutely. We've been excited to have you on. We cover what you guys do very frequently here on the Gray Report, whether it's in the newsletter or on our podcast and YouTube show. And so again, to have you on to be able to break this down, it's a real pleasure. And really what you've been covering has been at the top of mind for a lot of investors. Looking at really these macro forces, monetary policy, inflation, and outside of just talking about kind of just normal rent growth and CPI, you're really kind of looking at it from a different lens and a really pretty unique analytical standpoint. Before we get into that, for those who may not be familiar with Berkadia, what you all do, because you guys do a lot of interesting stuff. Can you guys just give us a quick overview of, what Berkadia is, who Berkadia is?
Berkadia is a joint venture between Berkshire Hathaway and Jefferies Financial Group. We're a full-service commercial real estate firm. We finance primarily multifamily assets, but we really offer a robust suite of services for our clients. So when it comes to a client's life cycle for their assets, we're there for the whole, every step of the way. We're there. So we have this three-pronged approach. We offer a platform for mortgage banking, number one. Number two, investment sales. And number three, servicing capabilities. So that's what we do at Berkadia. We're based in New York City, and I'm based here in Southern California. And what I do at Berkadia, I lead thought leadership as the company's economic analyst. And first of all, just appreciate the kind words. I think we're doing something special as well in terms of the kind of content we're putting out. And we're trying to answer those big questions. But before we get into anything else, I'll just run through our numbers. And I think this is not only indicative of a good year for Berkadia, but it very much was. But it's really just that 2021 was such a good year for multifamily. So I'll run through some of these numbers.
Yeah,
In 2021, Berkadia did $40 billion in mortgage banking volume, $27 billion in investment sales volume, and nearly $340 billion in servicing.
That's incredible.
So it was an incredible year for the company, but that's really because it was an incredible year for multifamily, right? A lot of investors are trying to come into multifamily, foreign investors. We can get into that, but it's just a really, really good market right now.
It really is. And, I think a lot of us, we want to feel like we are smart for being in the right place, but it really is the market, because everyone really did pretty well. You had to make some not great decisions to not have a great 2021 last year. And that really goes for, most assets. I think, multifamily and, industrial in terms of commercial real estate, were certainly the darlings and very attractive asset classes for a variety of reasons. But there's continuing talk of, could we be in a bubble, which is a perennial question that always gets asked. There's always a time when someone's asking that question. But if we are, it's certainly in an everything bubble of all asset classes globally, because there's just everything is expensive. Before we move on, though, tell us just a little bit more about how you got in to this space. How you got into analyzing the housing market, economics, and just tell us a little bit more about your background.
My previous role was at a global commercial real estate firm. So I've been in commercial real estate for a bit. And there I led the San Francisco Bay Area analytics team, which comprised the San Francisco office for the company, East Bay office, and the Silicon Valley office in San Jose. And so there I was primarily working on office and industrial product, and we were in the analytics space. So trying to help our clients, which included Twitter, Genentech, Clorox, and so on and so forth. So some of these big name clients, when do they sublease space? How do they do it? What kind of forecast can we help with,
Mhm.
and things like that. So really, it was really from an analytical point of view, but also from a portfolio management point of view in terms of helping these companies manage their real estate portfolios around the globe. That's my last position, and I've always just had an interest in analytics, in data science, and I think that's why I come to real estate with that point of view. And I think it's very much needed, right? I think a lot of these analyses are so simple, and sometimes you can simplify it, and that's fine. But you can only get so much insight out of a simplified analysis, and
Yeah.
sometimes you have to go beyond that to answer some of these deeper questions, and that's what we're really trying to do.
And it's not always easy. When we're talking about private markets, this type of analysis is, much easier when we're talking about, public equities, or bonds, because you can have access to more information. Now, where you're sitting at Berkadia, you guys do have, more information than your average investor, because you're seeing from the financing side or the transaction side, you guys do have some data, and there are obviously, data sources out there, but it's, much more either balkanized or just harder to find. So it has been really impressive the types of analysis you've been able to provide. And again, it's a different type of analysis as you'll find elsewhere. So even if it can be maybe a little bit intimidating because you don't necessarily understand all of the pieces, it's worth taking a look at and starting to learn, because I think you may start viewing investing and just analyzing markets in a little bit different way. But let's take a step back real quick, because there are so many macro forces that are driving markets right now. Obviously, real estate is hyper local, but there's just some macro forces that we can't ignore. Just curious on your thoughts of, starting this really big picture, global economy, the changes in monetary policy that we're seeing in central banks across the world. Um, What's your opinion on the kind of the outlook for 2022 in the future? And then kind of finally, wrapping that into multifamily.
Yeah, I think, if I just touch on multifamily real quick, because it's the
Sure.
first thing that comes to mind. Rent growth is widely being forecast to decline or decelerate in 2022. And, I don't know if there's a ton of evidence to suggest that. I think wages are going up. Sure, real wages are declining,
Yeah.
but nominal wages are going up. Renter incomes are rather strong, and the multifamily market seems to keep chugging along. From the data that we're looking at for January and February, the market seems to keep going. But from a
Yeah.
more global perspective and a more macroeconomic perspective, the global economy is in a big shift right now. That's for sure. And I think Blackstone just recently purchased a big bit of multifamily, which is really indicative of the fact that a lot of these institutional investors are piling into multifamily. It's an inflation hedge. It's this. It's that. All the things that we know about multifamily, I think, are really attractive right now because of the global uncertainty. And no one knows how many times the Fed's going to raise rates this year. In our paper, we say 3 times this year, 3 times next. I was based on the Fed dot plot in December, and now Bank of America is forecasting 7 rate hikes in 2022. And I think someone else was forecasting 11. So
Yeah.
we're
Wow.
talking some serious changes. We're talking about some serious changes in monetary policy, not only in the United States, but if you look also elsewhere around the globe, if you look at the European Union, you see that the ECB is expected to raise their deposit rate to 0 basis points. And they've been in negative territory for quite some bit. The ECB deposit rate right now is minus 50 basis points. So although Europe is a lot more comfortable with negative interest rate policy, it just shows that there's a shift going on here. And also from a global and really a national perspective, economically, the U.S. is in a pretty unique spot relative to other developed economies because we have spent pretty much the most as a percentage of our GDP on pandemic related stimulus. And so that's probably one of the reasons the US economy is experiencing inflation rates consistently since the pandemic started, which exceed our cousin economies like Canada, UK, Eurozone, and obviously Japan. So in general, big shifts going on, big changes in monetary policy, not only in the US, but also around the globe. And what it means for multifamily is there's a bit of uncertainty, and multifamily is very good for that.
So I have three quick follow-ups from what you just said. First on the rent growth to decline, because we've been watching a lot of those forecasts also, and there's a lot of forecasts for pretty quick tapering of rent growth. And what we try to continue to pay attention to also, though, is the difference between market rent growth and effective rent growth, and really kind of making sure we're talking about the same thing. Because market rents have grown anywhere, depending on which source you're looking at, anywhere between 12 and 16%, nationally year over year. Some markets like Tampa are high as 40% year over year. But that doesn't mean that every single lease in those markets have increased 40%. Just the average market, where you're seeing on, if you walk in or you go to an apartments.com or whatever, yeah, it's a 40% increase, but that doesn't necessarily mean all of those residents in that market are paying 40% more. And we're likely to see that growth of effective rent, being delayed over the next several years. And so, in a sense, it seems as though we have a certain amount of effective rent growth baked in over the next several years. How are you parsing that out in terms of, okay, maybe we're not going to see additional market rent growth, but we are likely to see effective rent growth and kind of nominal at a property, how it really affects people over the next several years? How are you looking at?
I think that was a very very eloquent way of saying it. I think that there is to some extent effective rent growth that's baked in for the future, and the multifamily sector is pretty much good to go in that respect. I personally don't see effective rents declining or decelerating rather
Mhm.
in 2022. And I would just point back to all of the strong fundamentals on the personal side, because really all this comes down to personal
Yep.
finance. Yeah, I mean, of course, personal finances are then connected to the macroeconomy and all of that. So, not trying to oversimplify too much, but personal finances are very strong. Savings are high. People are getting back to work. We have, people have such a large amount of options that we have what's now called the Great Resignation, and so on and so forth. So people are reevaluating their lives, and really, there's a lot of support for living in an apartment,
Yep.
especially with housing prices right now. That's another thing that's really catalyzing, I think, the market for 2022 is the housing prices. Although I think the last time I looked at it, the rate of growth is declining a little bit, but it's still growing.
In your mind, because you wrote a piece earlier, I think late in 2021, talking, really kind of poking at the term, transitory, as a way to describe our current inflationary environment. And I think you lead the piece with the Merriam-Webster's dictionary definition of the term transitory. And my idea of a transient is kind of a one moment event. It's a very brief burst. And I used to be an audio engineer, and when a transients in the audio world is like when like a drum hits, and it's a one moment and it dissipates very quickly. Or past that point of dissipation. Now, obviously, if you're looking at, you can define whatever period you want and call it transitory. Oh, it only lasted a year. It's shorter term. But the idea that we're not in a transitory inflation environment, it could be longer lasting. That kind of goes along with your idea that we're not going to see a deceleration of rent growth. But I keep coming back, and like, just curious of your opinion. At some point, are we going to, or when will we kind of revert back to this, slower growth economy? Because we do have these demographic forces, along with the Great Resignation that you mentioned of, baby boomers, dropping out of the workforce, retiring, downsizing, which can drive rental growth also. But in general, less spending, less velocity of money, leading to a less inflationary environment. It's more similar to Japan, kind of more similar to Europe. Is that kind of just that meta force? Is is that still with us? And when will that actually make this inflation transitory for whatever that definition is? Or are we in a new, just complete new economy forever?
Yeah, I don't know. I think it is likely that this kind of change in rate policy and pulling out of support for the bond market. I mean, in March, the Fed is going to completely stop all quantitative easing, so that'll just be a done deal. And what I'm referencing is, of course, the monthly purchases of mortgage-backed securities and treasury securities as a way to prop up the economy and keep rates down. I think all of these changes potentially could change this whole thing where you look at M2 money and it just looks like an exponential curve. And I think that is probably the big reason why a lot of the mechanics in the economy are just so starkly different than what they have been historically. It's just the amount of money that's in the system and the amount of central planning that's ongoing.
Yeah.
So I think to the extent that rate policy is effective in reducing economic growth, which I think it is wildly effective at doing that, I think we will see some tamed economic growth. I mean, the most recent metric was almost 7% as a compounded annual rate of change for real GDP, so real gross domestic output. And the quarter before that was a deceleration relative to the quarter before that. So that was a bit of a scare, and that's when everybody was talking about stagflation. But I think we're seeing some serious changes, and we're seeing some changes that are so big that I would think that you're right if you're saying that we will see a paradigm shift in the economy. But now, what that does to multifamily is just such a resilient asset class that it's really hard to disrupt it unless
Yeah.
you have some serious mismanagement at the Federal Reserve. And a lot of people are worried about that, right?
Yeah.
If
I mean, it's the one, I mean, they're the one institution that if they want to break the economy, that they have the tools to do so. And I don't know if I can point to too many other organizations that have that much power. And historically, I mean, they've gotten it right a lot of times, but when they get it wrong, the impact is pretty massive.
Well, yeah, and I'll give you an example, and we covered this in one of the papers, most recent paper actually. In 2013, then Fed Chairman Ben Bernanke, he sparked a bond sell-off, surge in rates. Although it was pretty, I think it was the response, the coverage was a bit overblown for the taper tantrum, as it was
Yeah.
dubbed. But it just shows how much power the Federal Reserve has. Even the words of the Federal Reserve chairman or chairwoman really reverberate throughout the economy. So we're seeing really a double pullback here. We're seeing the quantitative easing stop, and we're also seeing rate increases. And those together, we're really pulling the lever to stop this economic activity we're seeing
Yeah.
and reduce inflation.
And so, we really have kind of three pieces what the Fed is already started to do or contemplating to do. So, like as you said, we're ending QE in March, quantitative easing, ending buying of treasuries and mortgage-backed securities, the idea of several rate increases to the Fed funds rate, but then there's the tightening of the balance sheet also. Does that play much of an effect in the multifamily industry? Or, I mean, really kind of seems like the conclusion is that really relatively insulated, much more on the psychology of investors. But does that, I hear the unwinding of the balance sheet spoken about the least, I would say. Does that play a major variable into kind of your outlook?
Yeah, so we did a study on that, and we found that changes in the rate of growth of the Fed balance sheet do affect leverage department returns, but it takes about 5 quarters for that to happen. The degree to which those changes impact leverage department returns is really unknown, right? And it's
Mhm.
just such a variable thing that it's kind of pointless to really look into in any meaningful way. But perhaps we could talk about that because the timing delays that we found, because I think a lot of people are acting like these changes are going to be instant, right? We're going to see immediate changes in the multifamily market, and these are things that multifamily investors should be worried about right this second.
Yeah.
Of course, they should be concerned about it and plan, but there are some significant time delays, and I'd love to talk about that more.
Yeah, no, I think that your piece, real estate in context, interest rates, stagflation, inflation, and monetary policy was the perfect piece for the time we were in. I mean, I've personally sent it over to a lot of our investors outside of just, we featured it on our newsletter, and Matt and I talked about it, I think last week on the Gray Report, just doing a quick preview. But it really gets to the heart of so many questions that multifamily investors are asking, or at least concerned about, because it's what will rising rates, how will rising rates, affect multifamily acquisitions? What's going to happen to the market in 1 year, in 2 years? What if wages don't grow? What if we do see stagflation? And I think you made some, relatively, bold points backed up by evidence, and painting a relatively rosy picture, but really kind of backing it up with data that it's amazing how insulated multifamily is, and especially multifamily assets in secondary markets, the resiliency that they've shown. So yeah, and I'd love to kind of get into that. And because when I read, there were so many conversations about stagflation, which stagflation is typically high rates of inflation with high rates of unemployment as well. Now we're seeing low unemployment, low employment participation with relatively high inflation. But it was amazing to me to think that even in a stagflation like environment, multifamily still does relatively well. And I guess the question is, even with unemployment low, we do see negative real wage growth, and that's talked about as one of the major headwinds, to future growth. Is just, if wages aren't growing, then how is someone going to afford any kind of rent increase? And if rents increase 16% and real wages are up, not real, but nominally, 5%, how is someone be able to keep up with those rent increases?
Yeah, I think the answer to that is I think it takes some time for people to realize that their purchasing power is actually diminishing. And
Hmm.
that comes into, a more psychological thing. But I think there's a delay there, which is probably why it's not talked about as much as it should be talked about. But you talk about stagflation. So stagflation is a very interesting concept, and tricky thing is it's hard to study because we've only had really one bout of real deal stagflation in the 70s, right?
Yeah.
So if we're talking about real estate data, it's you're going to be pretty limited to find data from the 70s.
Yeah.
So what we did is we thought about stagflation in a more general sense. So we said, let's look at what happens. How do private apartments, the broad equity market, and the tech-heavy equity market, all proxied by their respective indices, how do they fare during times of quote quasi-stagflation? And quasi-stagflation is not something that we came up with. It's a term that the People's Bank of China I don't think they coined it, but they most recently talked about it in the context of that nation's economic status right now. So they were at least experiencing a bout of quote quasi stagflation, or that's just to say somewhat stagflation, but not full blown stagflation. And just to reiterate, you're right. Stagflation is just a period of relatively high inflation and sluggish growth. So however you want to define
Yeah.
either one of those, that's stagflation. So what we did is we said, okay, let's look at quasi-stagflation, and we define that as a period of time where inflation exceeds 3% and where the change in real GDP is less than the previous period. So we're
Makes
looking
sense.
at periods where we have a deceleration, we have going from a negative change in real GDP to a more deeply negative change in real GDP, and so on and so forth. So we're looking at periods where you're really getting worse in terms of real GDP. And what we found is that private apartments shine, right? And I think that was somewhat expected, but not to the extent that we found it. And what we wanted to do is we wanted to look at real returns in periods of quasi-stagflation. And I'll just throw the numbers out there. So this is to say that during times of quasi-stagflation, the average annual real return for private apartments is about 5.5%, compared to less than 4% for the entire US equity market, all actively traded stocks, proxied by the Wilshire 5000 index, and minus 2% average annual real return for the tech heavy NASDAQ index.
Yeah.
So you can see that quasi stagflation eats away at pretty much everything else, at least in a broad sense for equities, but not for private apartments too much.
How much is that driven by demand for, residents and performance at the actual properties themselves and more of a yield and cash flow? And how much of that is shifting in the markets and investor preferences? Some like what we're seeing right now, investors moving out of tech-heavy growth stocks, looking for more value opportunities, including real estate, including multifamily. So we're seeing incredible amount of investor demand, and at least currently seeing strong demand and performance at the property level. But in a true stagflation environment where we're seeing really low growth, maybe higher inflation. Um, does the investor demand offset the performance, or are you still seeing relatively solid performance at the property level as well?
I think it's both. It's definitely investor demand that's helping, but it's also at the property level. So you can see that during times of pretty much any kind of economically suboptimal, uh, during periods of any kind of suboptimal economic situation, people, investors move into multifamily. So that definitely has an effect.
Yeah.
But it just goes back to the fact that even if we're in stagflation, quasi stagflation, in a recession, people need somewhere to live. And at the end of the day, it's a very oversimplified take on it, but it's very true and
Yeah.
it's very applicable. And so, really, I think what the data are showing is that it doesn't matter what kind of economic situation we're in, largely. People need a place to live. Houses are expensive. And one way or another, that's going to be a priority for people. It's not like a company that's focused on building the metaverse. The
Yeah.
metaverse doesn't have to happen. You don't have to have the metaverse. It's going to be nice to probably have it. There
Yeah.
are
Why
obviously
not?
some downsides of that, but it's not your house. It's not your shelter.
You don't see the metaverse taking over, taking market share from just your normal real estate investors anytime soon.
No, probably not. Yeah, but I do think I think Facebook's having some real headwinds come their way.
Yeah.
With what happened with Microsoft and all that. So it's a really competitive landscape. But the
Yeah.
metaverse is very interesting. That's for
It
sure.
is, and that's probably a topic for an entire other episode that we should bring you on for, because there is a lot of interesting movements. I was talking to somebody who's looking at a fund for virtual real estate right now, so it is an expanding asset class, which is fascinating. So kind of just getting back onto what we were just referring to, in that so many economic environments, multifamily still performs, beats a lot of other asset classes. One question we were talking about last week, and we were kind of going over your latest piece, is when is not a good time to invest in apartments, because it's supposed to be in a more deflationary environment, which we essentially had up until coronavirus pandemic, kind of 2009 onward. It was relatively deflationary. I mean, we saw positive growth, but what's a scenario? Because I don't want people to take away that, oh, we're just multifamily is the best investment class and nothing can go wrong. What's an environment that multifamily, may not perform?
Yeah, I think you're totally right, and in no way am I saying that it's some kind of panacea for every need of an investor or anything like that. But I do think that it outperforms most asset classes in most economic situations. When it comes to times where it doesn't perform very well, I would say you're right. Deflation is the clear area where we see some significant declines, and a lot of that's driven by values going down. So your return on investment from a value point of view tends to plummet during deflationary times. A lot of that is just people going into more traditional safe haven assets. So going into bonds and things like that. It's not a panacea. It can definitely go down. And we even did a whole piece on multifamily return volatility.
Yeah.
If you play your cards right, you can really capitalize on the volatility of some markets, which is sometimes pretty great. That's to say the extent to which the returns go up and down is pretty great. So you can capitalize on that strategically. But I think you're right. It's not one fix all type of thing. That's for sure.
We try to be try to be self-aware at times and make sure we're not too much in an echo chamber and we're not just it's not a self fulfilling prophecy because we're obviously biased. We're both in the multifamily industry. We want multifamily investments to do well, but at the same time taking a step back and being objective, but trying to be objective, it the more the more research we continue to do, the more our assumptions are confirmed. And again, we want to be aware of confirmation bias, but it is a very robust asset class. I think relatively empirically. Um, I'm curious because just another. This is more talking about the downside. I've seen a lot recently, a lot of more opinions, not really reports. Um, Talking about concerns in some of the higher growth markets, such as a Tampa or an Austin, Texas, or a Phoenix, Arizona, of just a fear of oversupply. And this is on the single family home side and the multifamily home side. Um, Individuals taking a look at permits for new construction and pointing at that there's going to be a multiple 100% increase in inventory over the next year or 2 years, which will inevitably lead to a massive decline in housing prices, leading to a housing crash because we're in a great bubble. And as lazy of analysis as it is, just showing that, oh, well, we're building more houses than we were in 2007, 2008. Therefore, we must be building too much and we're getting ready to have a housing crash. Your opinion just on and I know your pieces, weren't focused on supply, but and I just know you track this stuff and are looking at it. Just curious on your interpretation of all the new supply that is in the pipeline, and are you seeing any signs that we're approaching an oversupply over the next 2 years?
I don't think we can say we're in an oversupply. I do think that the supply has reached a point where we are seeing a deceleration in single family home prices, which is something we should definitely be paying attention to. But I think developers are smart enough to see that as well. And I think market participants are able to really not overstep the boundaries in terms of oversupplying. Um, so I would say to say that there's going to be an oversupply um, and that we're going to have some kind of burst of a housing bubble, I think is a bit hyperbolic. I don't think housing prices are going to plummet. I think a lot of people are very emotional when they think about that because they see the housing prices right now and they're just insane. If you look at the Phoenix area, if you look here in Newport Beach, if you look in Los Angeles, if you look in the Bay Area, even house prices are just astronomical. But I think from a mechanical point of view, there's no reason they can't continue to go upward. From an emotional point of view, that's a different story.
Yeah. Yeah, no, that's true. And so much of this is emotional and psychology driven, whether we're talking about, housing decisions or investors decisions based on, their view of inflation. So much of it is psychology. And just as we were talking about earlier with the Federal Reserve, it's almost less on what they actually do, but more about what they say and what they, reading the tea leaves and whatever kind of mystical ceremonies people do to try to figure out what, Jerome Powell is, actually thinking and what actually is going on. Do you have metrics that you like to look for when you're trying to figure out, okay, what is the inflationary environment? Because, we've got CPI, PPI, we could look at the 10-year treasury, we could look at the 5 or the 10-year break evens. What are you tracking? And it's probably a variety of indices and metrics, but what are you maybe not paying attention to, and what do you try to kind of keep track of?
I think it's important to not put too much weight on some of the simple analyses. So I think people try to dissect something that's just a little too simple, and then
Mhm.
you're left with something that is effectively meaningless, right? You can only go so far with your analysis of where rents are going and where occupancy is going, and so on and so forth. So that's why we like to employ a little more econometrically oriented metrics. So, for example, we're talking about downside risk. Potentially what happens if we're in a down market, what happens? Well, two things come to mind in that context from a market analysis perspective. And the first one is the Sortino ratio. And a lot of people may be familiar with the Sharpe ratio, but I'll just give a brief explanation of it. The Sharpe ratio is a very simple ratio that tells you how many units of return you achieve per unit of volatility you endure. So volatility measured by standard deviation, the standard sense, and that's all kinds of volatility. So upside volatility, downside volatility, how much return do you get per 1 unit of risk, essentially? And the problem with the Sharpe ratio is something that I just alluded to about 2 seconds ago, which is that you're punishing your risk-adjusted return for upside volatility. And typically, upside volatility is welcomed by investors, although upside volatility may be an indicator or somewhat of a good predictor, somewhat of a consistent predictor of future downside risk. Most investors welcome it. So it begs the question: is there a measurement where we can get the unit of standard, the number of units of return per 1 unit of downside risk? And so that's what the Sortino ratio is. So hopefully we get a million, billion, trillion units of return for every 1 unit of downside risk that we endure. So it gets a little detailed with how you can, because it's a user selected thing, you can set a minimum acceptable return. You can base it off of your personal desires and your fund needs and parameters and all that stuff. So that's the first one, the Sortino ratio. The second one, briefly, is the dual beta model. And that one is very interesting because the standard beta that you talk about, or that people talk about in the context of stocks, where we say, if the S&P 500 goes up by 1%, then X stock goes up by 3%. So it has a beta of 3. We assume that there's symmetry in that relationship. So then a stock that has a beta of 3 would also go down 3% if the S&P 500 went down 1%. And that's just not empirically the case a lot of the time that assumption is held. So in comes the dual beta model, where we parse out and we have 2 different betas, and one is the upside beta and one is the downside beta. And for this exercise that we're talking about, the downside beta would be a perfect metric to look at. And that's because what you're effectively asking is, in a weak market, how much does our MSA or stock or asset or whatever shield us against market losses? So in a weak market, if the national apartment market goes down by 1%, let's say we have a market that will on average go down by 0.5%, the downside beta rather would be 0.5 or half. So generally you want to have a downside beta that's pretty small.
And what I found interesting in reading your piece is the conclusion or the observation that the secondary markets really had a more insulating effect to the downside compared to their primary market counterparts. Any insight into why exactly that is?
It's a bit of a mystery with exactly. I could speculate on why, but I'd rather figure that out from a data-driven perspective. Right now, we just know that it is. I think obviously secondary markets are just so different from primary, in that the volatility tends to be a little higher as well. That's probably something that's contributing to that. But you're right. There's another metric I didn't mention, which is inflation beta, that we really like to look at. And in terms of primary and secondary markets are more favorably sensitive to inflation. So what that means is just very simply, as inflation rates tend to rise, returns in secondary apartment markets tend to rise a lot, and more than primary. And that's not to say that primary are not as good. It's just that you have more stable returns in primary markets under rising inflation. But you do see more sensitivity in these secondary markets, and it's very interesting, right? Because your strategy should definitely change in those markets because of that. So you have a more favorable inflation sensitivity in secondary markets, and then you also have more of a propensity to shield against losses.
Just breaking that down. So, in secondary markets, which for listeners aren't familiar with secondary market, think not your New York Cities, not your Los Angeleses, or maybe even a Dallas, Texas. Think of, more of like, or Orlando or a Nashville or an Indianapolis, would be more of a secondary market. And so what the analysis is showing is that you have more downside protection in an inflationary environment, compared to the larger metros like a New York City or a Los Angeles. Now, I absolutely respect the desire to let's get some data to actually figure out why. If I could speculate, and you can just tell me if totally off base, but the primary markets are typically a little bit more efficient, in terms of capital activity, and they may be more respond quicker, to kind of moves in kind of the macro environment or speculating about the macro environment. And then in secondary markets, there's also can just be more slack in the market as well. Maybe less sophisticated operators. Maybe rents have just kind of stayed lower longer, and maybe more room for to move up and take advantage of growth and upside. Again, I don't have too much, really any data to back that up, other than just knowing that larger markets tend to have more capital activity, sometimes more sophisticated buyers, can be more efficient, more data. But that would be interesting to kind of see some data backing that up. But it was really good conclusions. And again, I recommend anyone who, if you're trying to figure out kind of the macro environment, how it relates to multifamily, and and really it's a piece is really required reading, because it kind of confirms some assumptions that we've always enjoyed, like secondary markets, and we have some, I think, empirical reasons why we've always said that we have, personally as a company, pursued opportunities in secondary and even tertiary markets. But getting some actual data points to kind of clarify that, I think was very helpful. So just again, that's the type of analysis that is beyond what you typically see in a report from some of the other organizations that put out multifamily reports, which they do great work. But, as we've talked about in previous episodes, kind of stick to your standard metrics of rent growth, occupancy, and more standard economic drivers.
Yeah, and I think the overarching reason for that, briefly, is that, and I pretty much said this, but just to reiterate, you can only answer so many questions with fundamental analysis. As soon as you start thinking about dual data and asking what happens in this market during a strong market, however we define that, what happens during this market in a weak market, do we show losses? In a strong market, do we amplify gains more than the market? Do we capture some of the upside in the market? How does that change over time? How is that related to volatility? All these kinds of things. You can get a lot of a deeper understanding of your market and make much more sophisticated capital allocation decisions. And that's really the whole reason for this. It's really not for fun, although sometimes it is fun to dig into the data. But
You
it's
can have
really
fun
to
at the same
support,
time.
yeah. I mean, it's really to support capital allocation decisions, support market selection decisions. The big question: what market should I go into? Let's say you have a new investor and you have 50 million bucks to play around with. Where do you put that? Right? I mean, most people qualitatively decide that.
Yep.
And that's something that, in my opinion, should not be done. It should be highly quantitative.
Yeah. I think that's the biggest challenge, is people make most decisions emotionally and, with their gut, and not necessarily using data. But if you actually have some of that, partially is, again, in commercial real estate, you don't always have the data. And so you're reliant on using your gut. So no, what are you looking out for here in the near future? Things are moving really quickly. What are you keeping your eye on over the next couple months?
We're definitely looking at the FOMC decisions. We're looking at what the market is thinking about, what the FOMC may do, and there's a 50% probability we see a 50 basis point federal funds target rate hike, which would take us to a target range that we haven't seen for a while. So definitely looking at Federal Reserve decisions, and the fact that Bank of America is forecasting 7 rate hikes this year. That's starkly different than what the market was expecting. we were expecting 3 rate hikes this year, 3 rate hikes next year, and now we're hearing numbers like 7 rate hikes this year, 11 rate hikes this year, and more next year. So we're definitely looking at the strongly changing macroeconomic landscape in the United States, but also globally, because a lot of global investors are looking at multifamily more recently as well. So we have to pay attention to the global economy as well, the Eurozone, the Middle East, so on and so forth, and looking at what the world's going to look like without the Fed engaged in quantitative easing, with the Fed out of the bond market. What's going to happen there with rates going up? How long is that going to translate? Looks like about 5 to 6 quarters from our analysis to impact multifamily. So that's not going to be an instant thing. And then also just keeping a really close eye on real wage growth. Although nominal wages are up, real wages are actually declining. But we don't think that that's any strong indication that the multifamily sector is going to suffer, because we think a lot of the other fundamentals are so strong that the multifamily sector is gonna keep chugging along.
Really appreciate you coming on. This was great insight. We'll be watching the macro, the Fed, where wages are moving. What's the best way for folks to either get in touch with you, get in touch with Berkadia if they're trying to get in, find these research reports, they want to reach out for, financing, research, data, investment sales. What's the best way to get in touch with you and the Berkadia team?
Sure. So you can reach me at my email. That's noah.stone@berkadia.com. We also have a research inquiries email. That's researchinquiries@berkadia.com. I'm also on LinkedIn. My URL ad is Stone Noah with no punctuation spaces or anything. So add me on LinkedIn. Happy to have a conversation there as well. And also just go to our website, berkadia.com, and you can really browse all of our different services and see how we can help you navigate this whole landscape here.
Awesome. Really appreciate it, Noah. Guys, what Noah's putting out is, I think, required reading if you are multifamily investors. So go check it out. Follow them on LinkedIn and check out the folks at Berkadia and all the services they offer. Noah, thanks again for coming on the Gray Report. We're looking forward to having you on again. Have a good one.